Hello and welcome everyone. Thank you for joining today's presentation on how to avoid emotional investing. My name is Destiny Lawhorn and I'm a Chartered Retirement Planning Counselor as well as a retirement plan consultant with Suncoast Trust and Investment Services. My role with Suncoast is to provide education, address any questions or concerns you may have, and then help you take that next best step to securing a better financial future through retirement planning. Now, before we begin, you need to know that neither Suncoast nor Nationwide give tax or legal advice. For such guidance, please contact your tax or legal advisor. Just a brief disclosure before we jump in. Feel free to pause the presentation if you feel you need additional time to review this slide. Now today we're going to talk about how emotions can interfere with a good investment decision-making process, and then we'll offer some concepts that may help you minimize the perils of emotional investing. To start out, we're going to broadly define emotional investing and why it can be risky to your financial health, paying particular attention to how market volatility can play with your emotions, potentially making things worse. Then we're going to discuss the pros and cons of market timing as an investment strategy and offer some ways to avoid emotional investing altogether. Most people may not realize that they are acting on emotions when making investment decisions. So let's take a look at what emotional investing is and how it can impact financial decisions. Now, for most of us, uncertain possibilities can trigger emotions such as excitement, fear, optimism, and anxiety. We need to understand how these emotions work so that we can deal with them appropriately as we make investment decisions. When making investment decisions, acting largely on emotions can be risky. Fearing that market prices are going down can produce anxiety, and that can lead an investor to sell or trade an option prematurely. It's easy and honestly quite normal for an investor to get excited upon learning that a certain fund has performed well or that market prices have gone up. Allowing past performance to be the sole basis for future optimism may cause an investor to keep an option when it may not be prudent to do so, or potentially worse, try to time the market. That's why you often hear the phrase, past performance is no guarantee of future results. But what happens if the whole market is moving in one direction or the other? Well, when markets are trending up over a significant period of time, it's called a bull market. It can be an exciting time. People start talking. Those who aren't already invested may test the waters, and when they feel confident enough, buy. But as you can see here, it may already be too late. They're buying high. Now, conversely, when markets move generally downward over a significant period of time, it's called a bear market. Early on, it's natural to just wait it out, but then the nerves start setting in, and this can be unsettling to investors. By the time they decide to get out, the market could be bottoming out. Emotional investing is getting in and buying solely or mostly because the market is moving upward. It's also getting nervous and jumping ship. That is, selling because the market is moving downward and you're just not sure where things are going. Trouble is, reacting emotionally to market conditions can turn the investor upside down. That is, you could end up buying when selling might be more prudent and then selling when buying opportunities are emerging. In just a little bit, we're going to offer some ways you can minimize emotions in your buying decisions. By the way, few market cycles run as evenly as this graphic displays. Most have fits and starts, and some can see quite a lot of movement in quick succession. That's called market volatility. Sometimes we hear the words market volatility and automatically assume that it's a negative thing for investments. Understanding what market volatility is and how it impacts investments over the long term is important in relieving some of those worries. So let's see why market volatility isn't all that bad. Market volatility is the rate at which market prices go up and down and usually refers to periods of quick price fluctuations. Up today, down tomorrow, maybe up again the next day. Such volatility can accompany a generally up market trend, a generally down market trend, or a generally flat market trend. When you get caught up in volatility, we can lose sight of the big picture. This is a view of market volatility or the big picture or long term. This chart represents the growth of a hypothetical dollar invested in the S&P 500 index on January 1st, 1950. Now, as you can see, that hypothetical dollar weathered a lot of ups and downs, but in the end, it saw substantial growth. In fact, since 1950, the S&P 500 index has gained an average of more than 10% annually, even with the 9 bear markets that have occurred during this period. The point is, market volatility tends to be a short-term event. Retirement plan participants tend to be long-term investors. Recognizing that volatility is a natural market activity can relieve some of that anxiety. So you can make those prudent, informed decisions that can help you achieve your goals through your retirement plan account. Market timing is a commonly used term, but most investors don't understand the impacts of trying to get ahead of the curve. Let's take a look at some of the impacts that trying to time the market can have on investments. So no one has perfect market knowledge. So some investors use a strategy that attempts to time when the market or a specific investment is changing directions. That's market timing, attempting to predict the future direction of the market through technical indicators or economic data. Because there are so many factors that can affect the market, it's continually debated whether market timing is truly possible. For those of us who don't have the time, energy, or resources to monitor the market all day, every day, market timing can be a hard way to manage an investment account. That's the first problem. Trying to time the market can be a time-consuming, costly, and ultimately futile exercise. And that's because there are so many factors that can affect the market that you can't control or even know about. Now, this chart illustrates a return on a lump sum of $10,000 invested in the Dow Jones Industrial Average from December 31st, 1998 through December 31st, 2013. By staying fully invested over the past 15 years, you would have earned $11,911 more than someone who missed the market's 10 best days. Now, this is a hypothetical chart that doesn't include fees, charges, and taxes, which would have lowered all the returns. Past performance is no guarantee of future results because investing involves market risk, including possible loss of principal. The point is time, not timing, is the best way to capitalize on market gains. Missing the wrong days is the second problem. The third problem is most retirement plans and fund companies usually enforce rules that prohibit or strongly discourage the kind of trading market timing requires. The reasons are twofold. So first, market timing can demand a lot of trades over short periods of time. Since each trade carries cost, market timing can drive up those plan expenses, which are borne by all participants. Essentially, all participants end up subsidizing the frequent trading of a few. The second issue is that fund managers make investment decisions based on the expectation of a steady base of assets that retirement plan participants normally provide. Frequent trading can negatively impact a manager's ability to achieve the fund's investment objectives, potentially harming all investors, including market timers. Emotional investing is hard work, and it rarely pays off. It can lead to underperformance and unfortunate outcomes. Next, we'll discuss several misconceptions and downfalls that can exist with emotional investing. The problem here is no investing is completely safe, meaning you can't lose money. Even with guaranteed investments, the provider could fail and not be able to pay back its guarantees. Now, money market funds are often thought of as a safe place to park money, but because money market funds are not FDIC insured, investors can lose money as they did as recently as 2008. But perhaps the most significant concern for the long-term investor is low risk usually means low returns. Lower yields may be dwarfed by taxes and inflation. Now, when markets become more volatile, it may be tempting to move into less volatile investment vehicles until things calm down again. But that can actually hurt your portfolio since their lower yields may be offset by taxes and inflation. So for example, in 7 of the 10 years from 2002 through 2011, real returns on 12-month certificates of deposit were flat or negative. It's tough to overcome even single-digit losses when several years of such losses get strung in a row. If a portfolio suffers a certain percentage of losses, it's not enough for it to just increase by that same percentage. It actually has to earn a higher rate of return to get back where it started. And in most cases, long-term investors are trying to get ahead. For example, a portfolio that's down 30% has to earn 43% just to break even. And that would take more than 12 years if in a safer investment such as CDs or money markets earning 3% annually. To meet your retirement objectives, you're probably going to need some level of market exposure beyond safe investments. We get lucky sometimes. It's a pretty good feeling. We get to thinking we can do this every time. We also face bouts of bad luck, and that can lead to worrying, and it'll happen to us every time. Let's face it, no one gets it right every time. That's why even the best investors diversify. Investors who follow a strategy are right more often over a long period of time than luck would permit. You're more likely to do better by making buying and selling decisions on a solid foundation of data and experience rather than trusting your retirement assets to luck. A lot of investors are still filled with doubts and anxiety over the markets considering the sharp market crash in 2008. They worry that another downturn may be around the corner and they've stayed on the sidelines rather than risk more losses. That's understandable, but it's an emotional response. By staying on the sidelines, you may miss opportunities for investment gains and compounded returns. So for example, the Dow gained 28% in 2013. Now, if you weren't investing in stocks that year, you missed those potential gains. More importantly, emotional investing over-focuses on the short term. For the most part, retirement savers are again long-term investors. So retirement investors need to look at the bigger picture and focus on those long-term objectives. That likely means getting back into the market. Downfalls of emotional investing are real. This chart is from a report by Wilshire Fund Management, a leading investment advisor and fund management firm. It shows that from 1993 to 2014, average stock fund return was 8.7%, while the average stock fund investor saw returns of only 3.7%. Why is that? The authors explain that a wealth of data has shown average investors are notoriously emotional when making investment decisions, and that results in self-defeating behavior. Wilshire calls it the performance penalty. Data has shown average investors lose out by making emotional investment decisions. Emotional investors can get stuck in that emotional cycle. That is, as the market goes through its ups and downs, the investor gets caught up in and repeats the mistakes he or she has already made. As we've seen, and this chart shows in another way, Going in and out of the market can be costly. Missing even a few days in the market can have a huge impact on your returns. Though it may seem there's a lot of consequences to investing based on emotions, there are many things investors can do to help them reduce it. Let's take a look at the top 3 ways to avoid emotional investing, as well as some of the best practices for managing your ongoing investments. So perhaps a smarter idea might be to find ways to avoid emotional investing so that you can allow a well-devised strategy to work for you. Here are 3 ways that you might use to achieve that goal. First, be proactive, having a plan in place rather than just responding to the market. Next, make investing a habit. And then finally, take that long-term view. Now, I want you to think of your prior investment decisions. Did you buy and sell on the buzz? That is, because friends, coworkers, or the media were talking about it. Did you sell because the market had already started dropping and you wanted to get out of it? If you answered yes to these or similar questions, you may be reacting emotionally rather than using an informed process. That can lead to lost opportunity. For example, short-term setbacks are common and frankly helpful for long-term investors because they allow one to buy while options are on sale, that is, at a lower price. Now, to become proactive about your investment decisions, consider the start, stop, continue method. So start by defining and following a strategy. Be sure it includes regularly monitoring your progress and allows for prudent adjustments as the situation dictates. Next, stop doing what hasn't worked. If you've had losses as a result of specific behaviors or decisions, do not repeat those. Continue doing what has worked, as long as doing so fits in the strategy that you've developed. If what you're doing doesn't seem to fit your strategy, consider why what is working is working. The answer can help you decide whether your strategy should be revised or what's working is a short-term thing that may not be suitable for long-term investing. Market declines often prompt investors to sell their shares and sit out on the sidelines within the market. On the other hand, a high market may keep investors on the sidelines, afraid of paying too much to buy shares. In either scenario, an investment strategy known as dollar cost averaging may help. Dollar cost averaging involves putting a set amount of money into an investment account at regular intervals, regardless of what the market is doing. It helps remove emotions from buying and selling decisions. Here's a graphical interpretation of the performance of a hypothetical investment that illustrates the concept of dollar cost averaging, specifically how it tends to lower the average cost of investing and allows individuals with smaller amounts to invest and to take advantage of low-cost opportunities within the market. Through this strategy, investors make consistent contributions over the course of time rather than invest a large lump sum at one time. This strategy gives investors the potential to reduce the amount they pay for each mutual fund share. And this may be the best part. Contributing to a 401k, 403b, or 457b type retirement plan account every payday is a classic example of dollar cost averaging. Now, our final step is to take that long-term view. This too is a strength of participation within an employer-sponsored retirement plan. So make a long-term investment goal and then create a plan to support it. Next, up and downs are going to happen. Don't be afraid of those downturns. They are a natural part of the market. Sticking to your plan despite those inevitable downturns can be beneficial in the long run. And then finally, make informed, prudent adjustments when appropriate. Now, speaking of prudent adjustments over time, you can be sure they will be needed. And here's one reason why. Let's say that you've decided that you're comfortable with a 60% asset allocation towards stock and a 40% allocation towards bond funds. What if a year from now you discover you're at 67% in stock funds? How do you feel? You might feel great, and that might lead you to keep things going as they are. But what if the market tumbled? Now you might feel a little anxiety. So what you do next could lead to emotional investing. That's why many investors consider asset rebalancing to be prudent. Asset rebalancing is simply the process of making trades in your portfolio to bring it back to the asset class percentages you defined within your investment strategy. So in our example, if your stock funds have grown out of proportion with your intended balance, you trade them for bond funds. Now, 2 important points. First, most investors do asset rebalancing in regular intervals, such as once a year rather than daily or even quarterly. And then next, asset rebalancing should be part of an overall review that takes into account other factors, including personal changes that may affect your goals. In short, it's something you may want to discuss with a plan representative or a financial advisor. If you're thinking to yourself, this is a lot more than I want to deal with, you may have alternatives. Now, your plan may offer lifestyle funds, which are mutual funds invested according to a specific strategy, aggressive, moderate, conservative, or some combination of them. The plan menu also may include target date funds, in which the manager invests for individuals who will begin needing some of their assets at a specified year. Because these funds are popular for retirement investing, many brands include the word retirement and the target year in the name, such as Target Retirement 2040, a fund that might be appropriate for an individual retiring in or near the year 2040. If you're looking for a more active investing style, look into whether your plan offers a managed account program. These programs are usually offered for an extra cost, but they do allow you to turn the keys over to the professional and let them do the driving. Now, to keep emotions in check, take a long-term view, but then stay informed about your investment account's performance. This helps avoid surprises, which can lead to impulsive decision-making. I want you to revisit your asset allocations regularly to make sure that they remain balanced with your investment goals, as well as your lifestyle and your risk tolerance. Next, I want you to check your progress to make sure you are staying on track with your goals. Then, make informed, prudent adjustments only when appropriate. And then finally, think it through before you act. Now, in the case that you experience a life event, these would be things such as birth, adoption, death, marriage, divorce. Each of these represents emotional times. They might not only alter your goals for retirement, but they can also trigger some emotional decisions about investing. That's why you should consider meeting with a plan representative or financial professional after any life event. They can help you make informed decisions concerning your investments or your retirement plan participation. Remember these important key points that we've covered today. Again, I want to thank you for joining me today. If you have questions surrounding your current investment strategy, retirement planning, asset consolidation, FRS or drop, please give us a call at 866-300-9382 or an email at ep_operations@suncoastcreditunion.com. Thanks, everyone.